Hello guys, welcome back. So today we are going to discuss about account receivables. So as we know, what is account receivable? It's a part of balance sheet or it's a part of a current account. If you are selling to your customers by credits, so you are creating account receivable. So there should be a proper management and control over account receivable to ensure the liquidity and proper control of the business. So if you see, once you are looking into your sales, you can see, suppose, let's discuss a case. Suppose you are working in a company. In your company, if you are looking into sales, you see that it is $10 million increased credit sales. At the same time, if you are looking into your account receivable, it's also raised or it's also hiked. So what is the real impact of that? You created more credit sales. At the same time, you have generated more receivable also. So that means that receivables may not properly collected, and once you generated that receivable, there is a risk involved in that receivables. You know, there are risk related to bad debt collection. So there are a lot of associated risk and cost are there with the account receivable. So if you are looking into the account receivable, if you are managing the account receivable, if you are looking into account receivable, you should understand how to manage account receivable. What are the accounting methods that you have to consider while recording account receivable? What are the provisions you have to consider? So this is about today's discussion. At the same time, in business, what will happen if you tighten your credit policy? Your bad debt expense or bad debt risk will decrease. At the same time, your credit sales also decrease. Again, if you are giving more credit to your customers, at the same time you are increasing your bad debt risk also. So there should be an optimum balance between this credit policy and your sales volume. So the core idea, what is actually account receivable valuation? It is the process of reporting receivable at their net realizable value. The account receivable you have to report only with the net realizable value, not the total value. You have total, suppose you have total 1 million account receivable. Out of this, just assume there are some risk factors. Suppose 10% you are expecting or 5% you are expecting, there is a risk factor on that. So you have to consider a provision for that risk factor, and you have, as a final account receivable, you can show only net realizable value in the balance sheet. Again, when it comes to corporate decision making, account receivable is not a balance sheet item. It's help us to predict the future cash flow, because these account receivables are going to collect in the future, and also it has to be represent the exact actual cash flow. That's why we are reporting the account receivable in only with the net realizable value, not the total credit sales. Suppose let's just look into some cases. If a customer credit rating drop mid-quarter, should the allowance should be adjusted immediately or at year end? So before going there, what is an allowance? Allowance, suppose you have a credit sale of 1 million and you are assuming that there will be a small chance of having bad debt out of this 1 million. So out of this, so you can create a provision or allowance for that. That what we called as allowance. This allowance value is based on the many factors like your customer's reputation, their credit rating, and your past experience. There are various factors are considering while we are creating a allowance for the doubtful debts. Suppose you created a allowance for 10,000 in this case. By mid of the quarter or by mid of the year, you get a report that the credit rating, one of your key customers' credit rating dropped. So what you have to do? Definitely you have to increase your allowance, because now you have a more risk of bad debt than before, because your customer's credit rating drops. So this is a consideration while we are looking into creation of allowance. That means you have to look into your customers, their credit rating, their past performance. Many other factors also has to be considered while you are creating a allowance or a provision for bad debt. As an analyst, would you prefer a company that factor its receivable to get cash quickly or one that wait collection? What does each choice signal about company's health? Before going there, what is factoring? Factoring means if you have a account receivable of 1 million, just assume, but your collection period is after, maybe your collection period is after 30 days, suppose. Then when it comes to factor, you can sell this account receivable to a factor with a discount, maybe they will give you 950,000. This is what we call the factoring, that means selling of account receivable to a factor. So here the question is, or the case is, would you prefer to factor or would you prefer to wait until the collection? So what is the answer? It's based on business case or case to case. If you need immediate cash, definitely you can consider factoring as a one financing option. And also you have to consider the cost for factoring. While it's come to factoring, there is a charge for factor that factor will reduce or factor will charge again with you. So that charge you have to consider, and your other financing opportunities you have to consider, the cost of your other financing opportunities you have to consider. So while before making a factoring decision, all these factors has to be considered. How does an aggressive sales strategy impact the allowance for doubtful debt? What is aggressive sales strategy? Aggressive sales strategy means you are pushing your sales to more customers. So if you are implementing an aggressive sales strategy, definitely you have to give more credit to your customers, you have to give more discount to your customers. So how it will impact the allowance for doubtful account? So if you have an aggressive sales strategy, definitely your allowance has to be increased. Maybe normally with a normal sales strategy, suppose you are putting 1% of your total receivables, but if you implemented an aggressive sales strategy, suppose you have to increase this percentage to 1.5% or 1.75% based on the risk. Then now let's come to US GAAP. The US GAAP, the account receivable must be valued accurately to the matching principles. That means if you created account receivable for this period, the expected bad debt from that period has to be reflected in the same period. If you have a account receivable in 2025, for example, what you are expecting as bad debt from these receivables, that has to be reflected in the same accounting period in 2025 itself. This is what we call the matching principle. That means our revenue the expense has to be reported in the same time while we are recording that revenue, or in the same period when we are reporting the revenue. Again, there are two approaches to create the provisions or allowance based on the aging of receivables. Based on the receivables you can create, and based on the credit sales you can create. Suppose you have a receivable of 1 million. So you can put a percentage of this 1 million as your allowance. The second case, based on income statement, that means you have a total 10 million credit sales. So based on the credit sales you can put an allowance, or you can consider an allowance. So there are two approaches are there. One is balance sheet based approach, that is based on the receivables or based on the aging of receivables. The income statement, the second approach is based on the income statement approach, which is based on the credit sales. So these are the two methods for calculating the allowance for doubtful accounts. Then let's move to next topic, that is financing of receivables. That means you have a receivable, that receivable means it's an asset for you. You can use that receivable as a financing source. That means you can factor the receivable or you can pledge the receivable. You have two options to finance by using account receivable. So what is pledging? Pledging means using account receivable as a collateral for a loan. That is what we call the pledging. So again, if you are using the account receivable as a collateral, still you retain the ownership of that receivable. Then the factoring. Factoring means you are selling your account receivable to a third company, to a factor for a commission. Again the factoring has two options. First one, without recourse. Without recourse means the factor bear the complete risk. Suppose A have some receivables, B, this is factor A, sell these receivables to B. Without recourse option, now B have all risk related to these receivables. That means if something not collected, that risk will bear by B. Then the without recourse means still the seller is liable for the customer. If any of the customer doesn't pay, the seller still liable. That means with the recourse, if there are, you already sell the receivable to a factor with recourse, that means if some of these receivables not collected, then they will return back that receivable to you and you have to pay for that amount. So without the recourse means you are transferring all the risk to factors, and with the recourse means still the risk is along with the business or with you. So these are the two options for financing with receivables, the pledging and factoring. So let us look into some corporate scenarios. A tech firm have 500,000 in account receivable, 400,000 is current, that means the latest receivable with a very low risk, that is 1% risk. Then 80,000 is 30 to 60 days overdue, which have a 5% risk, and 20% with a 90 plus days overdue, which have a 25% risk. So how you will calculate the allowance in this case? Based on the risk, it is based on the risk. That means for this 400,000 you have to consider 1%, that is 400,000. For this 80,000 you have to consider 5%, again 400,000, and for this 20,000 you have to consider 25%, that means it is a 5%, 5,000. So how much it is total? It is 13,000. So 13,000 is your total allowance balance should be. Suppose you have a credit balance in the allowance for doubtful account, you have a credit balance for 2,000 already. So you have to consider only the balance difference between. So your total allowance should be 13,000. You already have 2,000 in the balance. So you have to create a provision for balance. Only for 11,000 you have to create a new provision, because 2,000 provision already in your provision account. Your total expected risk is 13,000, 2,000 already there. So you have to create a provision only for the balance item, that means 11,000. Then let us move into next corporate scenario. A construction company has 1 million tied up for long term receivable, but it's need a USD 800,000 to start a new project tomorrow. They sell account receivable to bank without recourse for a 30%, 3% fee and 5% holdback for return. So the company will get 920,000 immediate cash. You have a total 1 million in this as a receivables, and there is a 3% free, that means there is a 3% fee plus 5% holdback, that means 7,000. That means 70,000 they will reduce from this, and you will get immediate 920,000. So it is 80,000, 3 plus 5% mean 80,000, and you will get immediately 920,000 you will get immediately. If you are selling factor, like if you are factoring your receivables like this. So how you will make a decision in this case? There are some other factors also has to be considered while making a decision in this case, because suppose, so this is your cost to sell this for factoring, that means 80,000. This is one option you have. Suppose you have a second option, you can raise 800,000 with a 50,000 total cost. So that means if this is the case, you can go with the second option. Or suppose if you are trying to raise capital from outside, it will cost you 150,000. So then the best option is to go with the 80,000 or factoring option. So it's all depend on the what are the options you have, and with considering the many other factors as well, like the outsourcing financing cost and other factors also has to be considered while making a factoring decision. Then the rules and logic for factoring calculation. The face value what it means, it's the total amount of account receivable sold. So in this case it is 1 million. Then the factors free mean it's a commission for their service. That means it's normally it will be the percentage of face value. Then the factors holdback mean they will keep a holdback, factor will keep a holdback. Suppose in case of any reverse of sales return or discount, so they will create a phase holdback on that. So normally it has to be a proportion of face value. So the net cash received, how much the net cash received? It is the face value minus fee minus holdback, it is your net cash received. So here are the some important consideration you have to remember while you are attending the exam. The first one is allowance for doubtful. Allowance for doubtful, as we discussed, suppose our total risk is 10,000. Suppose you already have a 2,000 allowance with you, then the balance 8,000 only you have to create additional. So the balance only, how much the balance to meet the total expected risk, that only you have to create as your allowance. You must subtract the existing balance to find the bad debt expense for the period. Then the recourse and versus non-recourse in the factoring. Recourse mean recourse and not recourse. Recourse mean there is it's a option in the factoring. Recourse and non-recourse are the option in the factoring. If it is with the recourse mean, if the customer doesn't pay to the factor, they will return that receivable to you and you have to pay back that received amount. Without recourse mean the factor bearing all the risks or if the customer doesn't pay. Then the direct write-off. As we discussed, the US GAAP is not allowing the direct write-off method because it is violating matching principle. So a quick summary what we discussed today, the valuation of account receivable, it has to be valued in the net realizable value. That means you have to reduce the allowance from the gross account receivable. Then the allowance is a contra asset account used to estimate future losses today. Factoring, what is factoring? It is selling of account receivable for immediate cash with recourse and without recourse. Without recourse mean we are transferring the risk also to factor. If it is with recourse mean still the risk will bear by the business. Then what is pledging? Pledging is using of account receivable as a collateral for the financing. While you are pledging, you are not transferring the ownership. Then the matching principle. Matching principle means the bad debt expense must be recognized in the period of sales occur, not when the account deemed uncollectible. So to match to compile with the matching principle, the US GAAP has to, as per the US GAAP, we have to prepare an allowance for the uncollectible or expected uncollectible. So let's look into multiple choice question today. A company uses an aging of account receivable method. At the year end, the required allowance is calculated at 15,000. The allowance for doubtful account currently has a debit balance of 3,000. What is the bad debt expense for the period? So before answering this question, you have to understand what is allowance for doubtful account. So it's a credit balance account. So this is your debit, this is your credit. For debit, you already have a 3,000. Your total required balance should be 15,000. So to match this, so how much you have to create as a provision for this? to how much you have to create provision for the current period to match this allowance. This is this required allowance. So your final balance will be 15,000. You already have a 3,000. That means you have to create another 18,000. Because the debit balance means it's a negative allowance balance now what you have. So you have to create another 18,000 or you have to expense 18,000 for this period to match your allowance requirement. So the option C is the right answer. So let's move into question number 2. When a company factor its account receivable without recourse, the transaction is typically recorded as collateralized loan, a sale of receivable when the risk of loss is retained by the seller, a sale of receivable where the risk of loss is transferred to the factor, pledge of asset. We just discussed without recourse mean it's all the risk we are transferring to the factor. So option C is the right answer. So this is what we discussed today is about account receivable. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.